The discussion, the topic of discussion is very broad. So it is basically Black-Scholes, Merton, and the finance industry, just to sort of think about how influential and how important the ability to price and then the options and then the way that has taken off has influenced practice as well as theory. And obviously through the day we have talks from both ends. The moderator today is Eric Rosenfeld. He's formerly a founding partner of Quantitative Alternatives. Arianne Adams, of what I think of as CBO, but Cboe Global Markets. CBOE, excuse me. David Booth of Dimension Fund Advisors. Peter Hancock, former president and CEO of AIG. And Bob Litterman of Kepos Capital. Both of these affiliations have sort of changed over the years. They're luminaries in the field. I think many of you probably know many of them. And let me get out of the way so that Eric can run the conversation. Thank you.
Thank you. Well, I have to say, we have an incredible treat in our goodie bags. And I'm not talking about the Black-Scholes coffee mug, which is always a treat. But in it, we have the syllabus of the first course that Fisher taught at MIT Sloan in 1976. I know because I attended that class. Thanks. I've been looking for these questions for the last 15 years, asking former students, and finally Roy Hendrickson unearthed them. So this is a real treat. This is the actual syllabus that Fisher handed out. It's titled 15423, The Management of Financial Intermediaries. But really it had nothing to do with financial intermediaries. It was just Fisher Black questioning finance. And I have to say, there's no textbook, there's no required readings, there were no exams, there's no homework, there's no TA, there's no office hours, just 100-odd questions. And Fisher would ask the first question on the first day and hopefully finish the last question on the last day. So he'd ask a question, and by the way, this course used to be taught by Franco Modigliani. So I took that course, and Fisher would ask the first question, and you'd inevitably give the Franco Modigliani answer. And, Fisher would, accept the answer and then turn to the blackboard and write in big letters, N-O. I never could figure it out, so I took the course the next year he taught it. The same questions, and there were totally different answers. So fast forward a year, and I took general exams here at MIT. And they consisted of written questions, and the next day there was an oral exam. The written exam had 2 required questions, and then you had to pick 2 of 10 questions to answer. So I walked into my oral exam, and Bob was running the show, and immediately as I entered the room, Fisher raised his hand. Bob called on him, and Fisher said, "I have just one question for Eric." And Bob said, "Go right ahead." So his question to me was, why didn't you answer my question on the written exam? And, there were maybe 10 questions to choose from. And I said, "Fisher, was your question the following?" And he said, "Yes." And I said, "Well, Fisher, I looked at that question and it was so simple and straightforward that I knew I had it wrong, so I chose not to answer it." Fisher immediately rose his hand again. Bob called on him, and Fisher said, "Okay, answer it." So I answered it, and he said, "You're right, you're wrong." That's how my general exam started. Well, before we begin, I would like to say a thank you to Bob and Myron, and of course Fisher, from all your former students. Paraphrasing Bob's father, we have stood on the shoulders of giants. You didn't just teach us techniques or solutions, but how to think about problems. The models will always be evolving over time, but you taught us a unified way of assessing financial risk and return, and how to understand and build intuition about the limitations of the models we use. You've made a profound impact on the industry and to all of us, so thank you. So to start off the panel, I'd like to ask everyone sort of the following question. What were your first exposures to the Black-Scholes Merton models, or to Bob, Myron, or Fisher themselves? And how did it affect the way you adapted financial models in practice? So let's start off with David.
Great. Well, my experience and first exposure to the models was back in 1971 as they were kind of being developed. You know, what had happened is that Fisher and Myron had gotten together to convince Wells Fargo to sponsor the first index fund, an account for Samsonite. And it was kind of the first application of passive management, and loosely called an index fund at the time. It was a bizarre portfolio. I won't get into that. And we designed it that way, or Fisher and Myron designed it that way, to have a chance of outperforming the S&P. It was an equal-weighted strategy. With equal-weighted, you have more small cap, and so anyway, blah blah blah. But the concern at the time, obviously, of passive management is you go to trade. How are you going to protect yourself from getting bagged by all those people out there with information? You know, lions eat zebra for a living. That's what they do. So, you know, how are you going to? And they came up with a very elegant way of trading, using, and that's my first exposure to the option pricing. The idea being that optionality has value, flexibility has value, and so they used the flexibility. They were the first to do that, so that was my first exposure to them, and it influenced my whole career. And my first exposure, well, and then along the way, Bob, of course, cautioned, you know, well, with flexibility, the more flexibility you use, the more opaque you become. You're less transparent, and the more trust is required on the part of your clients. And so that's kind of the two basic things that I got from the model that has kind of guided my whole career. Flexibility has value, and you know, it comes at a cost maybe of making it a little more difficult to trust.
Peter?
So again, I'm thrilled to be here. I feel a bit of an imposter not having attended any of these important courses, and I had the great pleasure of being involved in running an over-the-counter derivatives business for many years at JP Morgan. And you know, path dependency was a very important part of some of the challenges we faced, and I realized I had the wrong path. I was asked to trade options before actually learning about Black-Scholes. So I was like the dumb robot in the example of John Hull, where I was learning by trial and error. And one of the things I had to do was the week after Black Monday was to figure out why the interest rate options book that I inherited suddenly lost a lot of money, because even though all of the Black-Scholes Greeks were zero on the Friday, because the 2-year Treasury had dropped in yield by 120 basis points, it was no longer hedged, because we were long the high interest rate strikes and short the low interest rate strikes, and introduced the minor problem of strike mismatch. So that was my sort of moment of cursing Bob and Myron and saying, you know, this thing doesn't work. And later I had the good fortune of meeting them personally and in particular, my first encounter with Bob was just after German reunification. And it was a really interesting example of the positive externalities from hedging options. And what we had done was help the German agency, the Treuhand, that was given the job of how to finance East Germany, that suddenly had to issue literally hundreds of billions of Deutschmarks of new debt to fund the reconstruction. And there wasn't that much demand for 10-year debt because 10-year German interest rates had traditionally been very stable, 5% vol, and had jumped to 25% vol because nobody knew how expensive reconstruction would be. Is it 100? Is it a trillion? Nobody quite knew. So we suggested to the government, well, sell us puttable bonds, 10-year puttable after 2. That would calm down investors' fear. We'd strip the puts and we'd sell them to hedge funds in the US, who then dynamically hedged these puts. Well, one of the unexpected results of that dynamic hedging was that it stabilized bond yields because they were going against the wind. And so vol dropped from 25% to 7%. And that positive externality, A, made us quite a lot of money because we were short vol, but it also had a very positive externality in terms of making it easier to refinance reconstruction. And I like that example because most people talked about the negative externalities of dynamic hedging, and this was a very positive one. And Bob called me, and we discussed this, and our dialogue continued for the next 30 years. So that's always been a lot of fun. And I'm still a bit irritated at my first encounter with Myron, which was pitching Swapco to me because I was sitting on a AAA monopoly at JP Morgan, and then he broke the monopoly, so we had to share the spoils.
Bob?
Yeah, well, my first exposure was when I was a graduate student. I was a macro student at Minnesota, and we were very focused on rational expectations, University of Chicago, and I was working at the Federal Reserve Bank, and Fisher, who, as Myron mentioned yesterday, was very interested in business cycle theory, basically invited himself to give a seminar. And so it was a small conference room at the Fed, and there were about a dozen of us in there, and Fisher walks in, and he says he wants to talk about a Robinson Crusoe economy. He got up there and started talking, and after about 5 minutes, my advisor, Tom Sargent, asked Fisher something that was like, can you tell us a little bit more about the production function? And for those of you who know Fisher, and I don't know how he was in class, but this was the most bizarre seminar because he just paused, stood there for about a minute, didn't say a thing. You were wondering what's going on. He sat down, took out a notebook, wrote some things down and said, that's a very good question. And that was basically the end of the seminar. After that, it was a conversation, but I thought, very strange. Well, years later, I was invited to interview at Goldman Sachs. And luckily for me, it was in the fixed income research area. Fisher was in equity research. And so I went in to interview with Fisher. This is now, gosh, in 1986, and so many years later. And Fisher, he said to me, Bob, so you think you have some value to add on Wall Street? And now the truth was Goldman had invited me. I knew nothing about Wall Street, and I was a macroeconomist. And I thought, well, I'm an econometrician. Maybe I can estimate some parameters or something. It was a pretty bad answer, And Fisher said, yeah, you think so? He said, well, can you tell me what's the difference between a first moment and a second moment? And, I thought, well, yeah, I can define them, And I had no idea what he was looking for after I botched that answer. He said, well, first moments are like expected returns, and you might as well assume that they're unknowable. Second moments are like volatility. You can get them as accurately as one if you chop the data, so you might as well think of them as observable. I thought, well, that's actually kind of interesting. I had no clue. And I also didn't know that Fisher was at the time writing a paper, What's Wrong with Econometric Models? And for those of you who know that paper, it was kind of focused on confusion between correlation and causality. my advisor, Chris Sims, had written a paper, money, income, and causality. So I was a little bit in the crosshairs here. Luckily, I botched that one as well. And somehow I got hired. I don't know. At Goldman, they have this kind of history that if you get interviewed by 20 people and one person says no, you don't get the job. Luckily, Fisher was in equity research, and I did get the job and was able to get there. Now, years later, I was asked, in fact, Scott Pincus was here earlier. He may still be here. He was my boss. And he asked me to develop an asset allocation model. He said, this is back when the Japanese were buying up all the bonds around the world, and our research department in Japan wanted a global asset allocation model for bonds. And Scott said, I don't want separate models in Japan, in Tokyo and New York. And so, Bob, why don't you build an asset allocation model for our Japanese investors, for bonds and currencies? And I said, sure. He said, you should talk to Fisher and get his input. So I asked Fisher, there's a lot of models out there. What do you suggest? He said, well, I always like to start with the simple model, and then if it doesn't work, we can make it more complicated. So the simple model being Markowitz mean variance optimization. I never used a model like that, so I went back, read about it, programmed it up, put in the inputs. I thought, well, the Goldman economists, luckily I'm here, they have forecasts of, bond yields 6 months out for 19 different countries, 18 different currencies. I'll put all that in. And of course, the covariance matrix is very badly behaved. So I do an optimization. It's complete garbage. It's short 300% this and long. So, and then you change, I changed the inputs by like 5 basis points, well below the uncertainty of a forecaster 6 months out. The whole thing, goes completely bonkers in a different direction. And in fact, I spent several days thinking there must be a bug here. I must have put, percent rather than basis points, but no, that wasn't it. And I went back to Fisher. I said, Fisher, this mean variance optimization is incredibly badly behaved. He said, yes, well, that's well known. And I said, well, what do people do? He says, well, they put constraints on everything, no shorting, mins, maxes. And I said, well, if it doesn't work unconstrained, how can you trust it to add value? He said, yeah, no, that's a problem. And so I said, well, what do we do about it? He says, well, I have this equilibrium theory, and here's a paper, universal hedging. The interesting thing is, while I was programming this up, I had seen this paper. It was brand new. I thought it had nothing to do with, the optimization I was doing. It was a paper about, in equilibrium, how much of the foreign currency risk should an investor hedge. And he came up with a constant number. That's why he called it universal hedging. It was interesting. I thought, that is very academic. How is that going to help, right? But he's Fisher Black. I'm brand new here. I'll try it. And so I didn't even know what it meant. How do you put this equilibrium in? And I thought, well, at least it gives us another source of forecasts, the equilibrium forecast, and I have my economist forecast, and put them together. And of course, well, kind of dumb in retrospect, but I thought I'll do a linear combination, And as soon as you move a tiny little bit away from equilibrium, of course, everything goes crazy again. I realized pretty quickly, you need to take correlations into account. And then all of a sudden, incredibly well behaved. And, we went to Japan to market this. One thing we learned in marketing this tool is that even though there were a lot of quantitative investors who claimed they were using Markowitz, they weren't really. They didn't trust it, And so we came out here, we said, we have a better model. No one was interested. And so we started using it at Goldman. In fact, Cliff Asness was the first investor to really use the model. And after a year, he was up 95%. And I didn't really know that much about it. I thought, well, that's pretty good.
Was that after he was down 60%?
Not at Goldman. It was kind of, it worked very well at Goldman. And then, of course, he left, and I went into asset management. But anyway, it was really very practical. And here we are 30 years later, it's still around.
Arianne?
Yeah, no, wow, that was fantastic, fascinating. I've experienced some of the same interview tactics when I went through the rigor at Goldman as well. So I thankfully made it through it as well, 20 plus interviews. I'm here today to represent, or have the wonderful opportunity to represent Cboe from this perspective, and how impactful this academic work and model has impacted the entire industry. Cboe has this very storied history, with Henry Schwartz provided in the introductory remarks this morning, and Joe Sullivan, clearly the founder of the Chicago Board of Exchange, in April of '73, to shortly thereafter the dissemination of Black-Scholes and Merton that created the cornerstone of the options industry, and clearly still being utilized in fantastic fashion today. And it was the combination of those two that has truly created a remarkable backbone and opportunity for growth that we're witnessing and continuing to witness today and daily and even going forward. So what has that allowed Cboe to do is over the last several decades, 50 decades, as we've had our 50th anniversary, like we're celebrating the 50th anniversary here today, to not only educate and innovate. And we've really taken both very passionate about both, and hopefully some of the results have shown not only are we celebrating our 50th anniversary, we're celebrating our 40th anniversary of SPX, our 30th anniversary of VIX, which we would say is one of our most significant milestones in terms of an opportunity to have 30-day implied vol out there disseminated out there, and products traded against that index, which has been a very powerful tool for portfolios. And we've taken, what we have seen, we've taken these proprietary products as well as the option products, and we've seen them evolve. We've seen customers gain adoption, and that has seen the volume grow substantially. How do we do it? We've been listening to our customers. We've been listening to academics. We've been listening to portfolio managers and market makers, where they've said to us, we want the ability to trade more. So utilizing this foundation to say, maybe I need a smaller product because my account package or my account size is quite smaller, or I need a larger product because the assets under management that I need to manage are substantial and continue to grow. Or, topic du jour, the ability for you to be able to, maybe not, you need to wait to the third Friday to hedge, or the quarterly, or the leap. It allowed us to add the weeklies, and now backfill on the weeklies and add the Tuesdays and Thursdays. And this is where we've seen such adoption grow. I would say over the last 3 to 4 years, I wouldn't say it was an evolution. I would say an explosion of users. It's taken the user base from what maybe had been complicated, hard to understand, and I fear not, I'd say, to Main Street, where we've seen an adoption of the retail customer base. Maybe zero commissions might have driven a lot of that adoption, but I think people are learning and not fearful of using a derivative in addition to how they might use an equity product to be able to hedge or interact with the marketplace. The significant amount of growth that we've witnessed over the last couple of years, one, I would say from the diverse amount of users, customer base growing, but the ability for us to innovate and make access easier, whether that's on our phones, but more importantly, we've made options more readily available on a daily basis. And I know that you had mentioned, maybe we talk a little bit about what has evolved with the zero DTEs over the past year and a half. About a year and a half ago, we're having a lot of conversations with large institutional asset managers, one in particular, and said, Arianne, we need an ability to be more precise with our hedging. We're continuing to run similar strategies, whether that was 3 months, 13 months, several years, or even 1 month. But the ability for the precision around our hedging needs to be more nimbler. We need to be able to utilize optionality on a daily basis. So you adding the Tuesdays and Thursdays to SPX would be very valuable to us. But furthermore, the liquidity providers or the firms that might be providing liquidity or putting us in these trades, it would be an ability for them to risk recycle in a more effective way. And that qualitative data coupled with our quantitative data that showed that when we had an option expiry, Monday, Wednesday, and Fridays, our volumes, quite frankly, were higher. So zero DTE, or the ability to manage portfolio risk intraday, was already happening. It was happening about 20% of our volume. Now we backfill, fast forward to where we are today, and we've seen a substantial growth. This is all based off the foundation of what we've been talking about today, which has been great. What's transpired, and I think what's actually surprised us, is not only that we have seen institutional asset managers adopt or continue to use this strategy, and actually, quite frankly, probably use our data to backtest to see if it actually might improve some of their hedging tactics to be more nimble or in an intraday basis. But the retail brokerage platforms and the retail investors have become significantly more active with this product. In a way that I would say, I joke when I look at Henry right now, and I think he's had this conversation, maybe we've avoided the topic of this isn't gambling anymore. This is an ability for people to actually use an instrument that has a defined outcome, whether that's buying optionality or using vertical spreads or condors or flies, to be able to manage intraday risk, to pick a direction in the marketplace, or protect or just capture yield. And that is what we've seen transpire. I would say the initial model for this growth has come from the retail brokerage platforms. We're seeing the institutional community really actively catch up by backtesting and starting to implement strategies. And then furthermore, which is I think an interesting point as I conclude and hand it back over to you to ask the next question, but is that the liquidity providers and the firms have becoming increasingly more active in managing their own risk with this product. In the past, maybe they have used an SPX option, they might have used the future to hedge those positions, and those would tend to be the most active or traded product. What we're seeing with the liquidity and this ecosystem expanding, you're seeing it easier for them to manage risk on a one-to-one basis with that option that expires intraday, that they're also using the same options within strike ranges to manage that risk more effectively. And they know that that option is expiring at the end of the day, where maybe in the past that future or another product might not have had the similar maturity profile. So that expansion of the ecosystem has been very unique to see, and it's all based off of what we're celebrating today. And with this anniversary is with that first paper and the dissemination of this model coupled with an exchange going live has been a very powerful story.
I can't wait till we move to hourly options.
We'll start with noon.
Yeah. So David, speaking of early days of options, you had a story about the use of a Texas Instrument calculator.
Oh, yeah, well, actually, I'm not supposed to tell that story, am I? I think I'll table that till dinner time. Don't you think, Andy? Go ahead, I'll tell the story. So
that was a good setup.
We have Myron on video talking about the Texas Instrument calculators. Shortly after the paper is published, Texas Instruments comes out with a calculator with programmed the option pricing model on it. So Myron, being Myron, calls up and says, we kind of invented this. What do you, shouldn't you?
Yeah, a little something for the home team.
Yeah, yeah. They go, well, no, that's stuff's in the public domain, so we don't really have to pay you anything. So, okay, well, could you at least give me a calculator? And they said no. So he didn't even get a calculator from Texas.
Well, maybe we should open it up to the audience now that you've finished lunch for questions.
How does the Chicago Board Options Exchange trade off possibilities that the market prices are efficient, that they're generating, so there's huge value for people who are doing risk management, which doesn't use options, but using underlying instruments or making decisions about whether to do things from the idea of inefficiencies? Because I always get the question, that we have inefficiencies in the option market. The market's inefficient, people making money by making it efficient. But with all these instruments you're providing, it seems hard for me to believe the market would be inefficient, you know, and most likely is efficient. So I was wondering how you handle those questions or research on those dimensions.
That's a good question, Myron. Anyone want to tackle that?
I think I can take it from an exchange perspective, and I'll ask my colleagues to kind of backfill or provide some thoughts too. But there's a couple things that we talk about when we talk about efficiencies in the marketplace. And a lot of that stems from a couple things: technology, operations, enhancements, market structure. When we think about those pillars in terms of how we make pricing more effective and efficient for, one, the customer and the user base. And I think that the way that we think about, let's just say, our Cboe's major options exchange, which is our C1 exchange, which is a hybrid model where there's a concept of an open outcry pit where we tend to get this question a lot, and then where there might be transactions with people, manual intervention, and creating an opportunity for markets to be quoted and disseminated and actively executed in very quick speeds, albeit at the same time, we have electronic liquidity providers providing quotes at such magnitudes and speeds to also interact with this order flow. And what we've seen is that there has been such a substantial increase in spend from a technology perspective from our liquidity providers and our customer base in order to access these matching engines to execute in a more effective way, that really has diminished or evaporated maybe what one would deem as inefficiencies in the marketplace. So I think that we feel that, one, the market structure has evolved in a way that there's a significant number of liquidity providers, increase in the number of customers, that has enhanced the liquidity profile. Two, coupled with the technology that has provided an opportunity for access to be more effective, more efficient, nanos, milliseconds in quickness, where that slippage and that inefficiency diminishes. And we continue to see that the need for more capacity on the exchange side, albeit the market is growing at substantial rates, is almost equally as important for us as maintaining products and product innovation. Because the growth is happening so rapidly, we need to make sure our technology infrastructure is able to maintain the messaging rates, especially with options where it's magnitudes higher than what it is with the equity marketplace, to be able to sustain and continue to maintain great execution quality from a customer standpoint. So we see it from the vantage point of bringing buyers and sellers together and how efficient we think it has become. And I don't think the customer's ever had it any better. So that question happens less and less from my vantage point.
I'll just chip in on the issue of market efficiency generally. And for those who are in businesses to exploit market inefficiencies, the good news is I think the world is full of massive inefficiencies still. Some of them are temporary and not worth pursuing, but some of them are due to what I've learned from Bob to describe as institutional rigidities. And I can tell you in the insurance industry, the short Vega position in long-dated variable annuities dwarfs the Vega of all derivatives markets put together. And it's not marked to market. It's subject to regulatory capital rules that are completely different than what would make sense to the people in this room. And that's just one example of optionality embedded in an institution or framework that will not be resolved for decades to come, let alone many of the options that are embedded in government guarantee programs and so on that distort markets. So I think that these are unstable and unsustainable situations, but when they resolve themselves is obviously the big question. And so opportunities, but also I think threats to hidden optionality where people don't realize they're short vol.
I mean, I always kind of ask, what's the alternative? You know, if markets are inefficient, do we just throw up our hands and say, there's nothing we can do? Or are markets sufficiently efficient that we can use information from the market signals, you know, to make decisions? So, you know, I think there are inefficiencies, but does it really matter? But good question, Myron. It's that could be on the next general exam.
Hi, Eric. It's Ken Armstead. How are you? I had the pleasure of having Fisher as a neighbor when I was on the trading desk at Citi, and he had moved to GSAM, and he was there on OSLIP. One of my favorite papers is the Journal of Finance 86 paper called Noise, which introduces the idea that you can never fully know the value of an asset, and he assumed, well, let's assume it's between 1/2 and 2 times its true values, which always gave those of us in the momentum space an opportunity to make money. And so that was the basis of all of my trading development at Commodities Corp. And I wonder if from a macro standpoint, if you would comment on efficiency.
Ooh, I'm definitely not touching that one. Anybody?
Stump the
Macro is all noise, you know. Okay. Anybody else? Well, this panel concedes, so thank you.